What's up, guys? Welcome back to DCA. So today we have a special episode for you. We're going to be doing a discussion about the crypto market with the guys from Upside Down Data. And this is Mark and Joe. And I'll let them quickly introduce themselves.
Yeah, I'll get started. I'm
Yeah.
Joe. Today, we're huge fans of yours, so thanks so much for having us on. Really excited to get into it. So I'm Joe. I'm one half of Upside Down Data. So a little bit about me. I'm a PhD candidate in cognitive science. My research focuses on persuasion, especially in a marketing and consumer behavior context. And that definitely affects how I think about the market and investing from that psychological standpoint. A member of the crypto class of 2020. And Mark and I, he'll tell you about himself in a minute. We were in grad school together and in the same lab, in fact. We got interested in the data science and modeling side of Bitcoin and crypto. And we started delving into that. And that's what motivated us to start Upside Down Data. So that's a little bit about me. I'll kick it over to Mark.
Yeah, so I want to second what Joe said. Thanks for having us on. This is going to be a lot of fun, I think. I currently have my PhD. So as Joe mentioned, I was in the same program as him. Since graduated, now I'm a postdoc in a computer science department. So I have a lot of background in data science, modeling, statistics, those kind of things that I've been trying to leverage to help better understand the markets from a more data-driven perspective. So yeah, I'm a slightly newer entrant to the market, but I find it really fascinating. So it's been a really fun exercise to try to apply data science to these markets.
All right. And as you guys know, I was actually an economics graduate. So that's sort of where my interest in markets come from. Currently, after my economics degree, I went on to get a medical degree. So I'm a physician now. I'm a radiologist specifically. So I'm quite adept at sitting behind the computer all day and looking at charts. So these two guys actually, we've been in discussion very early since our channel started. Someone in my community, you may know him if you're part of the Discord channel, Codex. He sort of told me about these guys, and I started checking them out, and I've been utterly impressed by their work. I think, from my perspective, they're providing the highest level of data that basically you're going to find on YouTube. They're right up there with channels like Glassnode, etc. So these guys, it's a pleasure to have them on the channel, and it's a pleasure to be able to do this with them. Interesting fact is I won't drop the place, but we actually found out coincidentally after talking for about a month or so that we live in the same city. So just interesting stuff here. We'll potentially be doing this as a semi regular type thing going forward. So we're excited to do it, and this is our first try. So give us a little bit of leeway at the start because there may be some rust that we need to knock off, but we'll get the hang of it and we'll go from there. So with that said, Joe's going to lead it off.
All right, thanks, Jay. So let's get into it with the first question. And the first question I've got for you guys is about market uncertainty. Given the uncertainty in the market right now, what's the best approach for a long-term investor to manage risk under these conditions? I'm going to start with you, Mark. What are your thoughts about that?
Yeah, so I think that's a really great question because I think the difficulty that we're all in right now is that there's plausible explanations for the market to rally from here or to keep dumping from here. And obviously you don't want to get stuck on the wrong side of that ideally. And so I think there are different ways to think about. One of the things that I think about, and I think Jay, you talk about this on your channel a lot also, is really considering what assets you're currently invested in, that knowing when might be the time that's more applicable for higher risk positions versus lower risk or lower downside positions. So for example, Bitcoin and Ethereum oftentimes offer the best risk adjusted return, although obviously in big rallies, they don't necessarily offer the best absolute return if the market does rally. But in these kind of uncertain conditions, maybe sometimes it's better to go to those slightly more safe haven type of assets where you're not as sure, and you can still capture upside should the market rally, but you'd also minimize your downside should it collapse further. So part of it might be kind of like a portfolio management kind of perspective where taking stock of where your distribution is, and if you're exceedingly in high risk positions, that might be opening you up to higher downside should the market go against your bet. And certainly having models like Jay's DCA index or our upside down potential indicator can give you some idea of maybe where we are in the market, of if more downside or upside is maybe more likely, and you can make decisions from there. So that'd be my first reaction. I'll pass it over to Jay to get his thoughts.
Yeah, so, if you guys watch the channel or if you're new to, DCA, the number one way that I approach risk is via, your portfolio management. So what do I mean by that? Essentially, you know, you can't control where the market is going to go. And, if you've been in crypto for more than a month, you know that whatever you don't expect to happen is very likely to happen. So we have these wild, volatile swings in the market, and they persistently happen. And so, as Mark was, sort of alluding to there, is, having some sort of model that can be helpful. And, obviously that's one of the, primary things that we talk about on the channel, as well as upside down data. But at the end of the day, you have to keep in mind the fact that, from my perspective, these models, all of the models, any model that you can come up with, these were all created, and this is something we've talked about, these were all created in the setting of a general bull market in the economy. So, you have to keep in mind the fact that crypto, while sure, we've had these, massive extensions from a baseline you could think of, in the setting of these parabolic runs that the market's gone on in 2013 and 2017 and then 2020 into 2021. And then we sort of come back to a baseline, and this is sort of reflected in a smooth logarithmic growth curve that we've seen that has basically, you could have created the log curve back when Bitcoin was, a half a year old, and that curve has not been invalidated to this day. It sort of comes right back to that baseline. So what I'm sort of getting at here is the fact that, at any time we could see if the market goes on a true correction, like you saw in 2000 or, at times in the 70s, for instance, I think that's going to be your invalidation of that curve. So this is a long way of saying that the way I approach the market is by, using a dollar cost averaging strategy, because at the end of the day, in my opinion, these models are going to sort of, if we ever do come under a point where the general market sells off, I think that would sort of be an invalidation of at least the way my model is constructed. I know your guys' model actually goes back and looks at the stock market historically, and I don't know how that's implemented into the crypto model that you have, but I just sort of think that that's a consideration you have to have. And that's why I suggest never just FOMOing into the market, which is what you see just, that's rampant in crypto. People will have a 20% pump, and then people will try and dump into the market. But at the end of the day, if we, have some massive correction, then you're going to be sitting on an 80-90% loss. Whereas if you were dollar cost averaging in, it's sort of a way to remove the volatility, because you're decreasing your cost basis as you're investing more as the market goes down. So while that's sort of a doomsday scenario type situation, it's nonetheless in my opinion, a legitimate way to sort of manage that risk, especially in crypto.
I think that it depends on your risk tolerance to a large degree, right?
Right.
If the safe approach is to DCA and have basically no time preference, meaning just to accumulate on a schedule, maybe in a dynamic way, so that you're buying more as the market gets lower and buying less as the market gets higher. And then eventually, once you get into sell territory, doing the opposite, you start to sell and then you sell more as the market gets higher. So taking that approach with very little time preference is a pretty surefire way to go if you assume that over time, some period of time, the market is going to continue to trend up. And even in the context of a major correction like what you were talking about, Jay, if we saw something like the dot-com bubble bursting, we saw a sustained correction across equity markets, really across the global economy, that would definitely have a major impact on crypto, of course. But that still probably wouldn't invalidate a positive trend over time. Again, if your
Right.
time preference is really low, if you're willing to wait for as long as it takes for the market to recover, then you probably can't really go wrong with a DCA approach.
Right.
The one other thing to say is that, if your risk tolerance is really high, then, and you're trying to kind of catch multiples in your portfolio. So let's say that you're someone who's trying to get to 5 figures or 6 figures or 7 figures or whatever the case might be, then, dollar cost averaging into Bitcoin is probably not going to get you there. I'm not necessarily advocating for a riskier approach, but I think that kind of recognizing what your goals are is important, because if you're really looking for those big upside moves, then you have to be a little bit more comfortable taking risk. And I think what that comes down to is, having a thesis about where the market is going. And, if you believe that we're in a new trend now, then, that would suggest that you could be trying to catch some altcoin moves, because, if Bitcoin bottomed at around 33K, then, alts will continue to recover as they already have. But again, this is a conditional. I'm not saying that that's what you should do. I'm not giving any kind of financial advice, but saying if your goal is to try to, multiply your portfolio and become, have a bigger stack, then, what it's going to take to get there is calculated, smart, patient, but still a little bit more risk. Right. So, that's just to contrast that with that DCA approach. What do you guys think?
Yeah, go ahead.
I was just going to have a thought. I think this is relevant to both to some degree, because one of the things that I've been thinking about a lot in these current times is that, on the flip side of risk management is also this idea of reward management. And so, Joe, with your comments on, catching those big moves, if you do catch them, then it's also key that you actually capture the profits off of those. Just like with any kind of these strategies, is that if you're unable to get out of those positions, then it's not really going to be worth it too much to you. So one of the things I've even been thinking about as a factor of risk in and of itself is things that will lead to poor decisions in the moment. So I think we can all have on paper a strategy that's data-based, that makes a lot of sense, that's very rational. But then the problem is, once you get into the moment, you're riding that ride up, you're 5x your original position, everything feels great. Suddenly it feels a little bit harder to feel like you want to sell. It's like, oh, well, number just goes up, so I'm going to stay in this position. And so obviously emotions play a role. One of the things I think is actually really interesting about the crypto space, especially if you're on crypto Twitter, is just the social dynamics, the social norms, and the comparisons that get in there that can interfere. So something I've noticed is that in bullish times, every time someone talks about selling, they just get pounded. People are just like, oh, you're not going to make it, you idiot. Like, why are you selling here? But then, of course, when the market does what it did back in November, drops 50% or more for altcoins, then it's those same people who are saying, "Oh, I wish I had taken profits. Oh, why didn't you warn me? It's the opposite of it. It happens." And so it seems like, to some degree, trying to immune yourself from those social pressures can also be maybe something that's helpful in these situations. Where if you have a strategy and a plan, don't let other people's comments or their mocking you or anything like that necessarily pull you off of your strategy, because ultimately, if it's a sound data-based strategy, it should outperform some emotion-based strategy in the long run. So I think either in a DCA approach or in what Joe was talking about, if you have some disciplined thing that you're doing, don't let what other people are saying or emotions necessarily interfere, because that kind of, by definition, invalidates the strategy you're using. So that's just another thing that I've been thinking about in terms of risk. That's maybe just a slightly different take on that.
Yeah, and I kind of have two things to say about that. So first, I think that's sort of the benefit of using a model like we provide, the DCA index risk model, or your guys' upside downside potential indicator. It sort of is giving you an idea. Nothing's going to be perfect. I think it's often, I think there's a lot of misunderstanding about how these models work. I see it quite often, like, oh, well, Bitcoin, your model topped out in February. Yeah, well, it's not necessarily going to capture the exact top, but if you think about it, most indicators point to the fact that January or February were actually the momentum tops. And after that point, if you look at it, Bitcoin went up, another 10 or 15%. But if you were sort of taking those funds out, as we've discussed numerous times on the channel, removing those funds, putting them into altcoins, that's how you would have captured, you know, at least based on the, my perspective and my approach to the market, moving it from Bitcoin, which is obvious, tended to be in the past the first mover. We're not necessarily seeing that to the same degree right now, but there's a lot of dynamics going on in the market that appear to be developing and are new that we haven't seen before. But in the past, moving out of Bitcoin into the altcoins was giving you both protection from that downside volatility as well as a lot of upside by moving into the altcoins before many of them went on their large parabolic runs. So I think that's something, that's what our model is sort of providing people is, our model's a way to gauge when an asset may very well be approaching the top. You're not always going to catch the exact top. But what you see is, at least in the DCA index model, and I believe in your guys's as well, typically when, for some of the altcoins anyway, when you guys have noted a top, have you seen that there tends to be a large correction right after that, after it hits the highest levels of your risk model?
Yeah, I would say oftentimes it does. Sometimes what it will happen is kind of sideways consolidation, slight down before more upside might kind of finally be able to move past then. Usually the highest levels of risk happen after the kind of the main meat of whatever move is going to happen has happened.
Right.
So there's a lot of opportunity cost of staying in, even if a little bit more upside comes after, because usually you could have gone elsewhere and gotten a better return with that money. But yeah, oftentimes a correction, but not guaranteed. But usually
Right.
sideways. It's not going to usually just keep going right up from those points.
Yeah, that's just one thing I've tended to notice is, often I mostly look at log scale when I'm looking at price charts because you kind of have to in crypto because things don't happen on, it's like I always say 20-30%. I don't get excited about that. That's meaningless, just noise to me. And I truly mean that. The signal is on the log scale where you're seeing 5, 10, 20, 20x gains over time. But these things that look like sideways consolidation, if you actually measure them out, are often, still quite significant, like 50% corrections, even if it's for only just, a few days. So that's something I've noticed because when you're looking on the log scale, yeah, it looks like, hey, it barely moved. But in reality, it went down quite a significant percent. And it truthfully, oftentimes it can be just for a day or two before it starts its run again.
Yeah, I mean, just to kind of distill some of the points that you guys are making, I think one of the key psychological aspects of risk management is adjusting to those kinds of moves in all directions.
Yeah.
You just phased by. You have to be unfazed by the drawdowns, but you also have to be willing to take the profits and then watch the asset that you just sold continue to shoot up. And you just have to accept that that's the nature of the game. Mark, you were kind of talking about this profit shaming phenomenon that happens on crypto Twitter and elsewhere, where you're not going to make it if you're selling. I think not in every situation, but in a lot of situations, if you're finding yourself to be kind of contrarian, if you're kind of disagreeing with the mood in the market as a whole, you're probably on the right track. Again, it's not always going to be that way. Right. If we're in a sustained trend, then the euphoria is going to build and that'll continue for a while. But if you're taking profits when everyone else is, having their grandma come in and buy, then you're probably, your decision rule is probably calibrated right.
Yep.
And if it shoots up another 30%, whatever.
I have a perfect example of that. I don't know if you recall back in April or whatever it was, May, when Dogecoin was, going to the moon, going to $1. Elon was about to be on SNL and all this. And this is a true story. I was in an airport in, I think it was Dominican Republic or something. And I could see on my phone or, on their phones, I probably saw in this small airport with maybe 200 people, I probably saw 5 people on Robinhood. And, I can't say that definitively they were trading Dogecoin, but, it's a known fact that Robinhood, one of their key draws at that time was, Dogecoin. So just the fact that I saw that many people on, the Robinhood app in the airport, yeah, right at the time when Doge is, going up to, I don't remember what it was at the time, 40 cents or whatever, just sort of goes to that point. And then we all know it went on another little tiny run, maybe another 50% from there, but then crashed. And what's it at now? 15 cents. So it just, kind of speaks to that fact. The one other thing I would say is, I think, as far as the shaming type thing, well, at least up until I started my YouTube channel, and being a boomer of sorts, I'm 37 years old, sort of benefited me that way because I had no contact whatsoever with the crypto world at large. I didn't, I didn't watch YouTube. I watched some Ben Cohen videos, and that was about it. I didn't, did not have a Twitter account. I don't have a Facebook account, etc. So I had no idea what it was actually like until, until just recently. And, I can see how just the whole environment, the whole social media environment sort of leads people astray by and large, because I think there's just this emotional state to everything. I mean, the way you get viewers is by creating emotional thumbnails. And that just is a microcosm of the entire, the entire scene, in my opinion.
Boomer J.
Yep. Unfortunately.
So one final thought I have, just going off of that, is something that also seems important to some degree is calibrating expectations. So I think it's reasonable to have certain goals, but then also I think probably by and large it's better off to have lower actual expectations than what your ultimate goals are, because then you might be more willing to actually take those profits, even if you're not quite hitting your marks, if all of your data is telling you should be taking profits. So like Joe, like you were mentioning, if you are, let's say you are targeting a 6-figure portfolio, but all your indicators are flashing warning signs and you're not there yet, well, then too bad. It's if your indicators are telling you to get out, you should do it, even if you haven't hit your actual goal. So in some ways, hoping for the best but planning for the worst might be another way of thinking about risk management, where you don't let yourself get totally caught up in some goal or narrative that you may or may not be able to achieve. Take what the market gives you, and that's certainly going to be better off than if you miss the opportunity and it goes up in smoke. So just another thought I had on that point.
Yeah, that's an important point. Got to take what the market gives you. The market doesn't care about the size of your portfolio or whether, whether you can quit your day job. The market's going to do whatever it's going to do.
Absolutely.
So this is great. Let's move on to another question that I think will continue to, bring up a lot of these same themes. Another question on uncertainty, but focus more on the nature of that uncertainty. So, the market is uncertain right now, and that's a function in large part of the economy. So, we've got inflation rising. There's talk about tapering and interest rate hikes coming from the Fed. There's uncertainty about unemployment, about corporate earnings. We saw Facebook tank the other week. There's also political volatility across the world. So there's a lot of negative uncertainty there. But at the same time, there's also plenty of positive uncertainty about potential bullish catalysts like a spot ETF in the US, corporations buying Bitcoin. I mean, we just saw KPMG, which is a $30 billion market cap, top 4 accounting firm, just added Bitcoin and Ethereum to their balance sheets. Other forms of corporate partnerships and mainstream adoption. So when you think about uncertainty and just how these kind of external factors might affect the space over the next year, let's say, how do you think about that? What are the main things that you look for, and how do you weigh them and try to put them into a coherent picture together? So start with you, Jay, on that one.
I think one of the, actually, a lot of people might not like this answer, but one of the ways that I approach uncertainty is by, I'm not ignorant to what's going on with regards to crypto news, for instance, but I don't pay attention to the news, especially during bullish stages of the market, because I don't think the news truly matters that much. Obviously, we're not talking about like the macroeconomic picture here. I'm talking more on the level of, actual, what's going on with crypto. Because, it's kind of like the video that you guys did with regards to the article discussing the fact that when you're in a stage of the market cycle where you have all this speculation coming in. It really doesn't matter what the fundamentals of whatever coin you're looking at are. In fact, we see a place where, like the article discusses, technical analysis tends to matter more in the setting of these, parabolic stages of the market. So when we're in a situation like that, I try and avoid looking at the news because I don't want it to influence me emotionally, I guess. And then when we're in more bearish stages of the market, that's when I feel like it's better to step back, sort of look at what's going on, what's the big picture, looking at the macroeconomic events. Like you said, for instance, with regards to inflation, I think the markets, and not just crypto, but I think the broader market, as a whole, is just sort of waiting with bated breath to see what, how's the Fed going to react to it, because we're in this situation where, they just keep kicking the can down the road, and they just do it again and do it again and do it. Well, we're going to raise rates, and then okay, well, we didn't raise rates. Well, we're going to raise rates, and then they don't raise rates. So now I think we're in a position where it's better to step back and sort of look at what's going on the macro scale, because as we're going forward, people don't like this, but once the institutions get involved in crypto, it's going to become more like the stock market, and that's just the bottom line, because they are going to react to the situation in the way that they always react to the situation. So you're going, you can't on one hand want a $200,000 Bitcoin, and then on the other hand, say that, oh, manipulation, the big boys are playing in the game now, and because they have to go together. You can't get that type of market cap just by having pure retail and quote unquote whale interest. You need the the hedge funds to step in, and they need to get a piece of the pie, and they're going to play by different rules than we've been playing by all along. So you're going to need to start learning principles from the stock market, because I think you're going to see them. You're already seeing it. They're becoming more congruous with one another, and I think that's just going to continue to happen going forward. So, I think that's perhaps a bit tangential from what the actual question was, but that's kind of how I'm thinking about risk, at least in terms of a bearish versus bullish times, and kind of right now.
Yeah, well, I mean, there's a lot of good stuff in there. One of the things that you brought up is something that I think we'll come back to in a few minutes in another question about, crypto and equities and the correlation there and that whole thing and what that depends on, whether it'll continue. But let's kick it over to you, Mark, on this question of uncertainty and these kind of external factors, how you think about that.
Yeah, for sure. So I agree with Jay that I do think that stock market is having an outsized influence on the crypto markets currently. One of the things that I think is actually really interesting that some people have observed in the relation between, for example, Bitcoin and equities, is that in recent history, in some of these more big macro corrections in the stock market or recoveries, Bitcoin's actually sometimes acted a bit like a canary in the coal mine to some degree. So if you go back to 2018, the big dump that Bitcoin had at the end of its bear market, actually pre-staged a big dump in the stock market by several weeks, and then Bitcoin then corrected out of that along with the stock market. In COVID, Bitcoin dumped further, then recovered faster than the stock market, and then the same we just saw it recently in November, where Bitcoin started precipitously falling, and then the stock market ended up following a little bit later. So I do think it's an interesting connection. I think it goes back to what Jay was saying with having these big investors in the space, where when you have a high market seen as being really high risk, like the crypto market, it might kind of act as this little bit faster moving signal in a shift of sentiment, because if it really is this high risk point, it's probably the one that people are going to cut bait on most or quickest. But then also, if they sense the market shifting in the other direction, that there's a big run coming, it might be the place you start putting assets back into, and smaller market cap, you can really move it around more. And the other thing that I think is interesting that some people have talked about a lot is the fact that price action, both in crypto, but also just in general markets, oftentimes is reacting to things that are not the things that you think it's reacting to. So usually the market's already priced in the things that you think are currently driving it. And now the things that are driving it are the things on the horizon that we aren't actually currently thinking about. So not to say that the Fed and hawkishness isn't a recurring issue. I agree with Jay that what the Fed does is going to be really important. But to some degree, I think it's also going to be if the Fed starts doing stuff that's surprising from here. So I think that if we did just get kind of rate increases that were reasonable and expected, the market might be fine. I think there's some historical data showing that even when the Fed raises rates, the stock market oftentimes does quite well for 9 months to a year out from there before you might start seeing some weakness. So it's not to say that rate hikes always dump the markets immediately. And it could just be partly kind of what we're seeing now, where a lot of that gets priced in before the actual rate increase hits us. So obviously, I'm not making any predictions. We'll have to wait and see exactly how the markets react to what the Fed does. But I do think there would be a possibility that a lot of the kind of hawkishness and the bearishness has to some degree priced in, and we might be moving into other things driving price action in the stock market from what we're seeing right here. So that's a little bit more kind of short term. One of the other things I did just want to mention, because I think it's really interesting. I don't know if it's going to happen, but I'm just curious to get your guys' thoughts about this, is the idea about the geopolitical game theory around crypto and Bitcoin that might end up happening. And I'm really speaking this kind of off of what was going on with Russia, for example, where, Putin was making these overtures like, oh, well, if Russia has an advantage with Bitcoin, then why don't we try to exploit that, get a, competitive advantage. And who knows if anything's going to happen with that. But if it would, then, even countries that don't particularly like crypto or Bitcoin, there is that game theory where it's like, well, but just in case, if this is something down the road, we don't want to be left behind. And so some people I've seen different people talk about this, where beyond just the adoption of Bitcoin as legal tender, which is one way that nation states can get involved in the crypto space, there could be these kind of games that start popping up where countries don't want to get left behind just to hedge, in case crypto becomes a big thing that could start shaping the landscape, which would be slightly a different dynamic than just connections to stock markets and things like that. Because obviously big state players they're not going to care as much about where we are in the market cycle if they're trying to compete with a big, competitor. And I think it's also questionable if we want to be rooting for that to happen, if we want crypto to turn into some kind of geopolitical battleground, because obviously nation states won't have the consumer's best interest of a rival nation's at heart. And if you deploy the resources of a nation state, you can do a lot of damage potentially in an emerging market like crypto. But I just think it's a really interesting macro development that could happen that I don't know. It's just a more recent thing I've been seeing people talking about that I think would be interesting to watch. So I'll bounce it back to you, Joe, if you have thoughts.
Yeah, that's a really interesting question. I mean, in some sense, this is the nature of a technological arms race of any kind. I mean, we've seen the same kind of thing play out with a number of technologies. Maybe like the prototypical examples being like the atom bomb and then the space race. So there's still kind of these Cold War echoes playing out in a crypto context in interesting ways. But even leaving aside that particular history, it seems inevitable that different actors on the global stage are going to try to use it to their advantage to try to gain an edge over their competitors. I think that's what's happening, and that's not a stoppable process, right? That's a terminal process that's going to continue, and that's going to be a major driver of adoption. And so, I think that, also in connection to the question about relations to equities and the broader global markets, that is a real way in which crypto is different from equities. Where exactly we are on the adoption curve is a matter of debate, but we're relatively early, right? Like crypto has been adopted less than your blue chip equities have. So there's just going to be that force of adoption and more power brokers across the world, states, but also corporations and various kinds of institutions and wealthy individuals are just going to be getting their hands dirty in crypto more and more. So I think that that's in part inevitable. The one other thing though that is maybe worth mentioning is that maybe it's not all good news to have crypto involved in political conflict. I'm not sure exactly what I think about this, but I have been noticing kind of the polarization around crypto in the United States, which is maybe a bit different from, how crypto is being used as a political football in the domain of international relations. So when we're talking about Russia and the US, that's one thing. But when we're talking about the Democrats and the Republicans, that's maybe another thing. Um, and I'm not stating a political position at all. I'm just kind of observing that the United States political system is pretty polarized, and to the extent that Bitcoin becomes mapped on to our political polarization, where it's becomes a Republican issue and something that Democrats oppose, that's probably not going to be good news for any of our profits, right? That's going to bring contentious regulation. It's going to bring fights in Congress. It's going to limit adoption because if half the country is politically left-leaning or whatever the percentage is, those are people who are going to be less interested in buying crypto if they associate it with the other party. So I think that there are probably a number of things that are going on politically that matter. On the international relations side, my intuition is that it's probably just going to continue, and it's probably going to bring with it massive adoption across the globe. Internal political polarization and fights over crypto in terms of how we're regulating it in the United States and other countries worries me a little bit more. So I don't know. I guess I would argue for people to try to not fall into that trap as much as possible. We want Bitcoin to be adopted by everyone. I think that would be beneficial to all of us. So there's some thoughts on that kind of political dimension. What about you, Jay? What do you think?
Yeah, I kind of think, there's a few ways it could go. I tend to believe that if, Bitcoin becomes as you say, a piece of, or, something that one nation can use against another in terms of, some sort of geopolitical struggle, I think then you're opening yourself up to types of manipulation that you can't even imagine. First of all, especially if you get on the scale of, Russia is a relatively, at least when we're talking about, in the grand scheme of things, they're a relatively wealthy country. And, so that kind of worries me, crypto entering into that space. Now, crypto is a, fairly wide market. So, it's not like we're just relegated to Bitcoin. And I think it would be, I guess there's a lot of ways it could go, and I don't have a clear picture of what that may actually mean. In fact, I don't think anyone has a clear picture of what that may actually mean, because you don't know what the motivations of different countries may be, and whether they would, be in a place where they would like to see the market go up or down. And I think that could all depend on numerous different factors. As far as the whole Republicans are tending to favor crypto and Democrats are tending to be against it. First of all, I'm a bit surprised by that polarization, and I find it kind of interesting. When I was first thinking about the issue, I was kind of thinking it may go the other way, but it hasn't panned out like that. And right in vein with United States politics, you have to be binary in your thoughts about anything. You can't, there is no middle of the road type politician, at least who achieves any level of success in the U.S. And I think that's sort of a point against our political system here, is that we do have strictly speaking, we have a two-party system. No other party has any sort of political power in the U.S., and everything goes down party lines. It's like you either believe in all of these things or all of these things, or else you don't have anywhere to fit in. And crypto, unfortunately, it looks like is falling right down that same path, where the majority of Democrats are opposing it, and the majority, or I don't know about the majority. Some of them I don't even think are thinking about it yet, but it can't, like you said, it can't lead to anything good at the end of the day, having this split, because then you're going to have times when, the Democrats sort of are, if they have the presidency, and then, the House and the Senate. Then we're looking at legislation against crypto. And then if it goes the other way, well, then you're looking at, legislation for crypto. And so it just adds to the uncertainty in the markets. And, I understand that crypto is it's a global phenomena, but at the end of the day, the United States market still, has a very large impact on crypto overall, because it's at the end, it's the largest economy in the world. So naturally, by extension, there's going to be an impact. The one other thing I think worth talking about would be the fact that I kind of feel like the United States, and you're not, I don't know that you're hearing this a lot, but I feel like they have an incentive to sort of, we have Tether and USDC and all these other currencies pegged to the dollar. I kind of feel like the United States, if you step back and look at it, they have an incentive for these things to exist. One of the primary things that the U.S. thinks about is keeping the dollar as the world reserve currency, and I think these pegged stable coins sort of give them additional leverage that they wouldn't have otherwise had, in that people are trading these coins that are pegged to the dollar, for crypto, which is obviously a burgeoning asset, and many countries are now starting to adopt it, or well, not many, but El Salvador has adopted it as a legal tender, and I think you're going to see other, as you said, nation states start to adopt it. So I think that's something to consider, how that may affect the markets as well, or whether the U.S. will try and go ahead with its CBDC, and what they'll do. I think there's just a lot of things at play at the moment that aren't entirely clear. I don't know if you guys have any thoughts on that.
Yeah, so I think that's a really interesting point. I have some thoughts on that, and then also what we're talking about with the political polarization issue. So I totally agree with you with stable coins, where it is a little bit perplexing that the U.S. or segments of the U.S. government seem so averse to crypto, in the sense that it seems to be just perpetuating that mission of making the dollar be a central thing. I mean, it is those Tether is the largest market cap stablecoin. Nothing even comes close. It's
right.
The way that a lot of things denominate themselves. So it seems a little bit silly to go against that. And part of me suspects that if crypto becomes, going back to the bigger geopolitical issue, if crypto becomes a bigger consideration on that stage, maybe then it makes the U.S. government reevaluate its position, because they might realize that they have an advantage on that perspective. That's still our currency that's driving a lot of crypto use. Almost everything gets denominated in U.S. dollars. So I agree. I think that will be interesting to see how that plays out as the regulation around stable coins continues, and as that really heats up, which I suspect that'll come to a head in the next couple of years. It seems like we're kind of getting closer to that point. One thing I did just want to say about the political polarization in the U.S. is, I don't know if I have a slightly different take than you guys do. I see it as moving in the direction of liberals being against conservatives for, but I don't think we're quite there yet. Like, I don't think it's set in stone yet. And part of the reason I say that is that there are still a number of Democrats in the government, so in the House and the Senate, who are pro-crypto. When we had the big fight over the infrastructure bill, for example, it was actually a quite progressive, actually, Democratic senator who joined with some of the Republican senators to try to change the language around brokers and all those kind of things. I think the issue that I see in politics is that the loudest voices are on the Democrat side against, and the loudest ones for are on the Republican side. But I'm not sure that actually reflects the underlying constituencies. And especially if the issues that they raise against crypto are things like the ESG concerns, like the environmental impacts. That's things like those are very easily resolved if you just don't have Bitcoin as being the only crypto that you're thinking about, right? Because there are plenty of chains now that are actually, if not carbon neutral, actually carbon negative, some of them. So it kind of, that argument against crypto doesn't really stand on that platform. So personally, what I'm going to be watching is what happens over the midterm elections. So I think in some ways, we're going to find out how crypto falls along those dimensions during this midterm, because there are some Democrats who are running on pro-crypto platforms, and there are also some Republicans running on pro-crypto platforms. And I suspect that if they realize that that's a lucrative thing to do, like if they realize that running on a pro-crypto position gets you a lot of new donations or things like that, then I think we're going to see this become a bipartisan thing. I don't think people are going to be complaining too much. There'll obviously be fights about maybe some of the smaller issues in it, but I think it's totally feasible. It could become more bipartisan. But yeah, we'll have to wait and see. The money is probably going to ultimately do the talking. And so does the money fall down more on the, the banks trying to lobby against crypto because they have a vested interest in seeing crypto fail? How much money are they dumping into certain politicians? Are they choosing a side versus the money that's going to go on the other side, wanting crypto to succeed? And then also just individuals donating. Just something I think is going to be interesting to watch from here.
Maybe crypto gives us, an opening to a third party. I doubt it. I doubt it, but it's, wishful thinking. There are a lot of very, very passionate people that, I think crypto has a fairly strong lobby, and a lot of wealthy individuals in the US, in fact, some of the wealthiest, that have an extensive vested interest in crypto themselves.
I do have a little bit of a different take though, Mark. I think you're right about that. Maybe it comes down to the distinction between like elites and the general population. Politicians will, respond to their donors, right, and to pressure from powerful people and powerful institutions. But I feel like politicization happens in the culture. I guess the message that I'm trying to convey is just that, for our audience, if you want to pump your bags, probably the best thing that you can do is just like not talk about politics in a way that would be alienating to anyone, right? There's plenty of like polarized takes on crypto Twitter.
And that's all there is.
Right.
Yeah.
But like people tying it to their political preferences, you might be right. You might be right that like there's a philosophical argument for your side, but the point is that if what we're after is adoption and participation, we want people to spend their money to participate in this sector of the economy. If you want to pump your bags, then I feel like making it as distant from these other culture war issues is probably a good thing to do. Now, I'm not really disagreeing with what you said about the midterms, anything that either of you guys have said. But I do think that the cultural polarization and just like getting wrapped up in all the other culture war issues is like a potential pitfall, and we're all going to make more money if that doesn't happen. So I don't know. I feel like it's as simple as that. But I don't know. This is a really interesting topic. There's so much more that we could dive into here. I mean, one of the things we talked about was about the relationship with equities, but we also had a few questions from folks on Twitter that we were talking about getting to. So I thought that now might be a good time to bring a couple of those up.
Definitely, we can get to some of those other questions. I thought some of those were pretty good.
Yeah, they're really good. I can't resist. I mean, one thing that this is all really speculative, right? And it's really interesting and it's important and it's going to have an impact however it plays out. But on some level, I also think that the inherent uncertainty in these kinds of conversations and the fact that we never actually get an answer, we might have an expectation about what's going to happen based on politics or economics or whatever, but we never actually find out if we were right. Like even if the thing that we thought was going to happens, price goes up. You never know why.
Right.
Like maybe that's just an argument for like really sticking to the data, which I think is something that really brings our channels together, a kind of a mentality that we share, because the data are the data. You can't fudge it.
Yeah, and I think human behavior is consistent also, and that's why a lot of the types of analysis that we do, I think, has a lot of value because it removes all the all of the politics and all of the news and all of the all of that noise, and just when you're looking at the charts, it's why you see certain things repeat themselves over and over and over again, just because people are people and they're going to react emotionally to certain events. And, in my opinion, that's why we see a lot of the things play out in the way that we do. And it's why, getting into the data is so important.
That's actually a perfect segue to one of the questions that we got from someone, which is about market tops and retail FOMO. So the question was, is it reasonable to assume that market tops aren't just created by retail FOMO, as the 69K local top was made with much less retail presence than the 64K local top? That 69K was in October, and the 64K was back in April. So our new all-time high is possible without speculation from retail? So let's start with you on this one, Mark.
Yeah, well, I mean, I think I have to say, well, first I feel like I have to say yes. I feel like we just saw one back just a few months ago. So I think they're certainly possible. I think they're probably, you have to have the right conditions for them to happen. And I think one of the things that's been fascinating with the crypto markets throughout this whole past few months, really coming out of the summer, is the fact that even though price was kind of moving up, on the supply side, things still largely remained quite bullish. That the supply side still stayed fairly similar throughout that entire move. If you look at across several different metrics, you kind of see it. Like look at the hodl waves. There's only a little bit of distribution that happened by longer term holders at the all-time high, but it wasn't the massive distribution you see at those big macro tops like we've seen in the past. There's some other metrics like reserve risk that also tries to get at long-term holder sentiment. And what's really interesting about that indicator is it's actually been falling, which means more bullish sentiment by long-term holders as the market's been generally going up in price ever since the summer, which is actually the first time that's ever happened in the history of Bitcoin on that indicator. This is the first time we've ever gotten increasingly bullish sentiment from long-term holders as price goes up. So one explanation I've seen for that recent top that makes total sense to me is that we didn't have particularly bullish demand, but because the supply was constrained enough, it was enough to grind price up to those levels. And then it's a little bit of an open question of what would have happened if we didn't get the macro bearishness that ended up coming in that I think kind of overran what was going on in the crypto market and drove us down. It's very possible that in an alternate scenario where the stock market stayed bullish, the Fed didn't come in with talks about raising rates if interest hadn't, or if inflation hadn't gotten out of control, maybe we would have just been gearing up for another big run to the upside. Obviously, that's just speculation. Who knows? But certainly from a supply side, it didn't seem like long-term holders were at a point where they thought it was a top across the board. Distribution did happen, but it wasn't this massive movement of old coins to newer hands. So I think for me, that's one scenario where it's very plausible to get a new all-time high without that retail FOMO. But I do tend to believe that those blow-off tops that we see in the market are probably more likely to happen when you do have retail FOMO. And it's because it seems like you can only get so far on the pure supply side, and you'll need that big kick of demand to really push you higher. So that's just my perspective. Jay, I don't know if you have a different thought on that.
So yeah, I think obviously, as you said, the answer has to be yes to that question, just because simply we've seen it happen now. But I think it's all about the nuance that matters. And as it regards to Bitcoin, I don't think you're really going to necessarily see these parabolic blow-off type events. I don't think you're going to see these anymore. I know it's not a popular answer, but I think there's more at play in the market now. The market is significantly more complex than it was back in 2017 or particularly 2013. In that you have institutions entering the market and you have the derivatives market. So when you run into these places where you start seeing, the FOMO retail buildup, first of all, you're going to see big time money players. They're not going to be able to get out at the top. So they're not going to attempt to get out at the top. And we've already seen a willingness for these institutions to take profits. We saw Tesla do it under the guise of doing it to test the market liquidity. Well, you can look at the order books and see if the market liquidity is there. That's BS. That's a BS answer, and it's just something to say. They did it to take some profits at the end of the day. And moreover, you're going to continue to see when you're in a buildup into a FOMO blow-off type top, you're going to see essentially the derivatives market sort of, you're going to be building longs, and then they're going to get liquidated. And that's going to be, this manipulation that we hear about all the time. And I think that's going to prevent particularly Bitcoin from ever doing that again. Now, with that said, I think individual large cap altcoins may still be able to have events like that. And that's sort of naturally where that type of activity is going to shift. But I think you're going to see Bitcoin shifting into, I think we'll still have large swings to the upside and large swings to the downside. but I just don't think you're going to see it go, Bitcoin anyway, go do something like a 5x in a month or so. All of that notwithstanding, the market cap is what it's at $1 trillion right now, or close to it anyway, and it just becomes all of those other things. Even if you remove those from the equation, it becomes harder to get that same type of move as the market cap goes higher and higher, because it just requires exponentially more dollars to get each new multiple.
Yeah, I mean, I think that speaks to another question that we got, which is a little bit of the inverse of this question, and it touches on a couple themes that both of you guys brought up. This is a question from Kodak's actually. If we were to get a massive correction taking us below, let's say 26 to 28K, would you think that this would have a huge impact on institutions, pushing them to sell at those prices to cut losses, and how would that affect how people perceive Bitcoin, and specifically how big companies perceive Bitcoin going forward?
Just to clarify, you said. Sorry, Joe. Just to clarify, you said if it drops down to like 26K or something like that.
Yeah, and would that motivate institutions to sell at a loss, and would that then harm the reputation of the asset for other big companies? Could that potentially nip this institutionalization trend in the bud? So Jay, what do you think?
I have a pretty strong answer about that one, and that's these institutions aren't. We see market manipulation all the time, with the relatively smaller market that we have right now, or with smaller players in the market anyway, right now. If you have these institutions, and we're in a place where they're potentially going to eat a major loss, they have the ability to drive the price up and sort of create at least enough retail interest. I'm not saying that they can create necessarily like a FOMO type event, but they can create enough retail interest to provide the liquidity that they need to get out of the market. Now, if you have something like Bitcoin gets hacked, Satoshi rug pulls Bitcoin or something like that, then, who knows what could happen. But under normal market circumstances, I think they will sort of, they'll create the situation for themselves to, we're saying without some sort of invalidation of the base level thesis of Bitcoin as it is. So there's no fundamental level change in the market. I don't think that they would panic sell. For instance, MicroStrategy, that's sort of the gold standard of what you have to look at. And I don't think there's any way in hell Michael Saylor is going to panic sell just because the price drops down to 26K. Now, if it's going down to 5K for some reason, then I think we're looking at a fundamental issue. And then who knows?
So, institutions, if they get caught with their pants down, they'll take someone else's pants.
Yeah, they'll take someone else's pants off and put them on. Yeah, exactly.
Mark, did you want to add something?
Yeah, I mean, my thought, I agree with what Jay said. I think when people have that much, capital to play with, they're in a different ballgame to what, us small players are in. One thing I was thinking though is that, kind of the flip side of what we were talking about with, sell side liquidity, there's also buy side liquidity and wanting to get in at the most favorable price they can get in at. So like Jay was saying, assuming that nothing crazy would happen like a hack or, rug pull on Bitcoin or something like that, it could just be that institutions would just see that kind of price action as being a great opportunity to get a huge discount on Bitcoin that could set them up for, years to make massive profits. And if you do get one of those big capitulations down there where a lot of people are selling, then that's the way you can scoop up a lot without driving the price up in doing that. Because obviously when you're a big institution, you have to worry about slippage. And if you're buying too quickly or if you're moving too much money in, you could actually influence the price and hurt your entry price and all those kind of things. So I would probably be more leaning on the side that they might just double down and buy more at a huge discount rather than just panic sell out. But that's just my intuition there. Joe, did you have other thoughts on that?
Not too much to add beyond what both of you have said. I mean, I tend to agree. The one consideration that seems relevant that hasn't come up is just that it takes a while for an institution to actually make a purchase. So one thing that I wonder about that I don't actually know is, once you go through that process, you get approval through your board and whatever other steps you need to go through to actually make the purchase or to make the sale. can you then kind of try to snipe it? Can you get in position, wait, or try to drive the price down and then buy there? I don't know what kind of precision is possible for these big players. But what we do know, I think, is that in general, there's a process that takes a while, even months, before they can make a big purchase or a big sale. And so that also seems to limit a kind of impulsive panic sell, basically.
Yeah. And to that, to what you just said, I think two of the questions we've talked about today sort of tie in hand here. I think a lot of institutions don't want to get too involved at the moment because of the political climate that we were mentioning before. Compliance is what it's all about on the institution level. And they don't know what it is they have to comply with just yet because the regulation is all playing out in real time. So I think that, a lot of these institutions are sort of waiting for clarity before, they're willing to get in. And like you said, that's going to take months. It's going to take months of time before they can, get board approval, then, find a buyer. They're going to go over the counter. They're not going to do it on an exchange. You're not going to see a whole bunch of buy volume on one day just because, whoever Microsoft wants to buy Bitcoin. They have to find a storage solution that they're satisfied with, et cetera. So there's a lot of considerations that I think these institutions need to go through, because remember, they have to answer to their shareholders at the end of the day. And when you're on this level, you have a lot of, at the end of the day, old guys with a lot of money that don't understand technology and aren't going to be happy about their company taking on this kind of risk. So I think that's something that needs to be considered. At least I think that's why you're also not seeing just this. There was the narrative that 2022, just institutions, they're going to be FOMOing in. Institutions don't FOMO. They can't FOMO. So I mean, they can be excited about something and want to get involved, but they can't FOMO.
So KPMG made this decision months ago, and we're just hearing about it now.
Yeah.
People in the know at KPMG have known about this for a while, and undoubtedly there are other institutions who have already made the decision to buy Bitcoin, and we're just not going to find out about it for a bit. So we're really operating at kind of like in an information scarce environment, if you want to think about it that way.
Yeah.
We know what we know, but we don't know what's going on in the smoky back rooms.
Right. And I think a lot of institutions, it depends on what kind of institution you're looking at. If you're like a corporation, you may have less incentive to take on a risk asset than if you're, say, a corporation that sells financial assets, because then you have an incentive to get involved because your customers are going to want access to that instrument. So, if you're Microsoft, you may not want to touch it right now because there's just simply, at the end of the day, not much for you to gain, because they're not going to make something like, they're not going to make 10% of their portfolio Bitcoin. It's just not going to play out like that. So, the marginal profit that they may get from that asset may just outweigh the risk at the moment, or the risk may outweigh whatever the potential gain to them is.
Yeah, and I feel like another thing that's relevant to this discussion also is the idea of like a spot Bitcoin ETF or a spot Ethereum ETF or something like that. Because for some ways that helps institutions in several dimensions. Yeah. It helps with custody. They don't have to self-custody their coins. They can rely on a third party, which presumably will have a very good system in place if they're able to get this approval. It also helps with clarity about compliance, because if the SEC approves that product, then the SEC has approved that product, and so it really helps them on that angle as well. And I feel like that's part of why it's been so contentious here in the United States, is because we do have these political forces that haven't really figured out where things are going to fall out on, and the SEC is kind of caught in the middle of that to some degree. So if and when that spot Bitcoin ETF comes out, it could offer a new on-ramp for institutions. But then, of course, when that would happen could also matter, because if it's in the middle of a bull run, that could be a top signal where everyone's just trying to grab the extra liquidity and get out. So you never really know how it would play out from that perspective. But in the long run, it might just make it easier for institutions to get involved. But then, of course, with all the caveats that we've been talking about here with time and things like that.
Wait, I thought there was a spot ETF. Isn't MicroStrategy? Isn't that what they are?
Well, yeah, essentially, yeah.
I think that this is a perfect time to wrap up the conversation. We can always pick it up next time. We didn't manage to get to all of the questions that we got from folks on Twitter, but we have them, we note them, and we'll talk about them next time. So thanks everyone for participating.
And we have the answers. So, go ahead, Joe. Sorry.
We're the only
Yeah.
Nobody else has.
Yeah, that's right. We're the only ones with the answers. Yeah. So.
All right.
Yeah.
Well, this is fun. Thanks, Jay.
Yeah, no, thanks for coming on, guys. And then, the next one that we do will probably be on the Upside Down Data channel. So we'll just do it like that. So this was, in my opinion, a great conversation. I had a lot of fun. So thanks, guys.
Yeah, thanks, Jay.
Thanks.
Oh, you're cutting out, Joe, but, he's saying goodbye.